Hey everyone, how's it going? This is Richard and welcome back to the TraderLion channel. And in this video, I'm going to be talking about how to deal with a situation that every single trader goes through, and that is handling failed breakouts. Now, there's a really important part of risk management because you want to make sure that you're limiting your downside while also not being completely shaken out of a potential winning stock. So there's kind of a fine line that we have to walk here. And I'm going to be talking about specific strategies and techniques that you can use to make sure that you handle these failed breakouts correctly. So with that said, if you do enjoy this tutorial, go ahead and leave a like down below right now. And of course, subscribe if you want to see more videos just like this one every single week. And with that said, let's dive right in. Okay, so here is the agenda for today's video. First, we're going to quickly cover what is a breakout. And if you're completely new to this and want to learn more about, capturing breakouts and buying at that pivot point, I've made a complete video about that. So that should be popping up right now. But we're going to kind of run through this pretty darn quickly. Then number two, we're going to talk about why the overall context and market environment is really important when dealing with failed breakouts. Then we're going to discuss how to manage your stop losses to make sure you're not shaken out unnecessarily. We're going to talk about normal versus abnormal action after that breakout, so you know when something is wrong versus when a breakout is likely to basically lead to a nice strong trend. And then we're finally going to talk about setup resets and then some final key takeaways. So with that said, let's go ahead and dive right in. So first, what is a breakout? Well, it's basically a powerful move through a set resistance level or a pivot point. And like I said, definitely go ahead and check out the pivot point video. I think it's extremely well done and explains the concept really well. So go ahead and click that if you haven't watched it already. And basically make sure that you're familiar with what a breakout actually is. This is an example over here with PLTR. We've got a range that's set within an overall longer term base, and we get a strong push through here on volume. And that's basically at its simplest form what a breakout is. So it's here, it's breaking out of this longer term range, and it starts a nice trend where we can basically make profit very quickly and basically ride that to higher prices. This is a momentum type of setup, and that is important to remember because this works best in trending environments, and we'll get into that in just a second. And breakouts can be used on multiple time frames. So some people are day traders and they're trading breakouts on a 5-minute time frame, while other people are more long-term investors and they really want to be sticking to the daily and weekly charts to identify those pivot points and then those breakouts through those resistance levels. So that's at its basic form what a breakout is and a little bit about the type of setup. So let's talk about why overall context matters. And this is something that I didn't specifically know starting out. This is something that I kind of learned over time. And you basically want to ask yourself, when should you trade breakouts? Well, as I mentioned previously, this is a momentum type of setup, and it works best when both the stock and the rest of the market is in a nice trending environment. So here we've got a chart of the NASDAQ 100 ETF, the QQQ, and we've got some longer term moving averages, the 10-week moving average in blue, the 30-week in red, and the 40-week in black here. And using this type of chart where each of these bars represents 1 week's worth of price action, we can basically identify the longer term trend of the market and identify whether we're in stage 1, 2, 3, or 4. And breakouts basically work best as we're just emerging from a stage 1 basing pattern or are already in a strong stage 2 uptrend. So this is the period where we want to be buying breakouts right here as well, coming out of this correction, here as well, and then here as well. In 2020, we saw so many breakouts work, especially in that kind of April and May timeframe. So it's important to remember that breakouts work best when the market is strong, the sector is strong, the industry group is strong, and the individual stock is just emerging from a nice, well-formed consolidation. So that's kind of the difference between bull and bear markets, because when the overall market is in a downtrend below the moving averages, it's tough for individual stocks to really fight the market, and likely any moves upward, any breakouts upward are going to be sold by institutions to basically provide liquidity for other positions. So that's kind of the difference there. So you want to look at the action of both the indexes and individual stocks very carefully and identify basically whether we're in a strong bull market or we're in a bear market or corrective period where things should, aren't working quite as well. And we should, instead of being offensive and looking to buy those breakouts, we should be a little bit more defensive. Additionally, you want to look at kind of how stocks have been acting at pivots. So a pivot is basically the spot, the line of least resistance, where we want to see a strong breakout through that level. And if a lot of stocks are failing at those pivots, it's probably not a good idea to be buying breakouts until they actually start working. So wait and be patient until the overall conditions improve. Now, I also want to mention this warning from William O'Neill about buying breakouts during bear markets. Here it is right here from page 151, I believe, in How to Make Money in Stocks, which I highly recommend if you haven't checked that out already. Basically, he says you should not buy breakouts during bear markets. The quote is right here. Most of them will fail. And he's absolutely correct. You want to be very careful when the market is in a corrective period because, as I mentioned before, a lot of institutions will use these breakouts as points of liquidity and sell into them. And basically, you can buy early in the day, think you're doing super well, you're up 5%, and then at the end of the day, we close right at the lows and you get shaken out or even take a loss. So be very careful during bear markets. You want to shorten up your time frames and take profits a lot quicker and just take overall smaller position sizes than when we're basically in a strong bull market. So that's basically why it's so important to remember that the overall context matters and that we want to be trading and buying breakouts when they're working well and the probabilities are high that they'll be successful. And when the market is correcting and breakouts aren't working, we want to be more defensive and avoid buying them. That's just kind of common sense. So with that said, let's move on to stop loss management. And we'll go through a full example of AMR here in just a second. But first, let's talk about kind of the overall theory here. So when it comes to initial stop loss placement, it depends a lot on your own personality and the individual setup itself and your trading style. However, you basically want to set it at a point where the setup has failed. So that could be the low of the day, that could be the low of the week, that could be the low of 2 days ago, the low of the higher low. It all kind of depends on what you like to do personally and kind of your risk tolerance as well. So once you've got that initial stop placement, and personally, I set it at the low of the day because I'm a little bit more aggressive. When do I decide to move up my stop loss? Well, it depends on the environment. So in an environment where things are a lot choppier, more volatile, I'll be more aggressive with moving my stop loss up to break even or even a little bit of profit, plus 1%, plus 2%. So I'm basically guaranteeing a green trade. But if things are really working and things are trending and my personal performance is, strong, then I might give the stock a little bit more leeway and room to work because the market is kind of cleaning up mistakes versus during a corrective market when the market is going to turn, on a dime and stop you out quickly. And you basically want to make sure that you're protecting any gains and profits that you do have. So it really depends on the environment. However, a good rule of thumb is that once you've got a profit of 1 to 2 times your initial risk, so if your initial stop loss was 4% below your buy point, if the stock moves up 4% and you're in 4% profit to 8%, which is 2x that initial 4% loss, that's a good point to move up your stop to break even. You can also look at higher lows on a lower time frame, such as the 65-minute chart, and use it to basically move up your stop slowly. That's another way to do it using kind of market structure. So it kind of depends, once again, going back to your personal style, your basically risk tolerance, how you want to do this. And it also definitely depends on the overall environment. There's also a question that I get asked quite frequently, which is, do you honor your stocks on a closing versus intraday basis? Personally, I do it intraday. During a strong bull market, like I said, I want to give my stock a little bit more leeway, and I might let it kind of work itself out towards the end of the day, see how things are closing. But typically, I've got my stop set in with my broker, and it's on an intraday basis that is activated. But once again, this kind of goes back to your own style. There's a lot of that there. I'm gonna say that a few times, but find what works for you and look at your math, look at your own results, and see what would be best for your own style of trading. And basically, the overall goal is to balance profit protection and also at the same time giving the stock room for normal fluctuations. And normal fluctuations, that's a kind of key phrase here. We want to avoid abnormal action where the stock reverses hard on larger volume than the breakout. That's basically a red flag, and we'll go into that, I believe, in just 2 slides here. But first, I want to go through an example of AMR here. Or actually, I think this is Arch Resources. This is the pivot right here. You've got a short-term flag, and it was acting really nicely, decently low volume during this flag. It was pretty tight here, and you've got a clear short-term downward trend line here, which you can use as that pivot point. So basically, the idea is you want to buy it as close to that pivot right here as you can, and then immediately, right after you buy, set your stop loss. Now, in this case, the higher low is right here. The low of 2 days ago is also that same low. and the low of the day is pretty close to that level as well. So it kind of depends on the setup as well, which is kind of the more obvious and clear spot to place your stop loss. But for me, I personally would set it at the low of the day here and let that work. So as you can see, we progress nicely, nice breakout on volume. We form higher lows as we go, trending nicely above the rising 21 EMA. And once you've got 2x that initial risk, which I believe would be about 4 or 5%. So once you're at this point, or even at this point, you can move up your stop loss to break even, or even as it basically progresses higher, you can see these higher lows form, and you can move your stop loss to here once we're at this spot. And then likewise, once we get here, you can backstop it to this level, or even use that 21 EMA or 50 SMA to trail that stop loss. So as I've said before, I'm not going to say that there's one way to do it, because it really depends on your style as well as the environment and strength of the sector and the market as a whole. So kind of find what works for you, and yeah, just let the stock work and let it do these normal zigs and zags while riding that longer term trend. Okay, so now let's talk about normal versus abnormal action. And this is a phrase that I've taken from Mark Minervini, who talks about this a lot in his book here. Basically, as I said before, zigzags are completely normal within a trend. It's just a part of, market fluctuations, normal average true range movements. And basically, we want to let the stock work as long as it's healthy action. We don't want to get stopped out by this normal up and down. So basically what you want to do is watch for red flags or caution signs like large drops on volume. As I said, if the stock drops and reverses completely on larger volume than the initial breakout, that's a sign that I would take to get out of the position, because likely it's not going to work. Likely that's institutions selling into that liquidity. We've also got undercuts of ranges. So if it fails that pivot, that's definitely a potential violation. And then, as I mentioned before, or just now, losing pivots or recent higher lows, that's definitely a sign that the market isn't quite right, and the stock setup is just not working at that time. Maybe it just needs a few more days to reset, and then it'll go again. But at that moment, the market is telling you that your timing was not correct. So it's important to listen to this and recognize that this is abnormal action. And instead of kind of normal action where we're just kind of forming higher lows here, we want to avoid this type of movement in our stocks. So here's a zoomed in view of FSLR from earlier this year. We've got a breakout on earnings through this resistance level. And this is definitely normal action here. We're moving up quickly on nice volume, forming higher lows above the moving averages. But then here we form another short-term base just a few weeks long. We've got an attempted breakout. And then the next day you can see we reverse, lose that low of that breakout day, and fall back within this range. That would definitely be a caution sign. And if your stop loss was the low of the day or even the prior day's close here, you likely would have been stopped out here and avoid this potential drawdown. Now, this ultimately recovers, but obviously we manage risk in real time. We never know what's going to happen. This could have completely reversed and filled this gap, and you don't want to be stuck holding that losing position when the setup really failed, as it lost, this area right here, the pivot, or even especially this higher low. So exit when the setup fails. So here it ultimately recovers. It also loses the moving averages before moving up once again. So this is an example of both really strong action, higher lows, riding those moving averages higher, and many stocks after a strong breakout will hold that 10-day moving average on a closing basis. And then here we've got an example of abnormal action where we reverse immediately in basically the next day after that attempted breakout. So this is a good example of both what to look for here and what to not look for at this moment. Okay, so moving on to the last concept here of this video, let's talk about setup resets. What actually happens when a stock reverses, fails a breakout, and stops you out? Should you get angry, put it on a do not trade list? No, that's absolutely not what you should do. And there's something, once again, I learned very quickly because often, a stock breaks out, fails, resets, and then breaks out again. And that's the time when you're not in it that actually ends up working and making a nice move. So when a stock fails a setup, you want to make sure that you keep it on your radar and put it on a watch list that you check every single day to basically monitor it to form another setup, another pivot that you can trade adequately. Because often that shakeout that shook you out also shook out a ton of traders, and that could be the last contraction before it really gets going and starts a nice trend. So remember that the setup can reset, form another pivot. Shakeouts are completely normal. They happen all the time. and it only has to work once to basically pay for all those aggravation trades, those stop outs. If a stock stops you out basically at 4% losses 2 times, even 3 times in a row, 20% gainer pays for all of that and then some. And that's what we want to do, especially when we're trading concentrated positions. So here we've got an example of AMR. Earlier this year, we've got a move up the right-hand side, a breakout. It forms a short-term contraction, and if it was going to be normal action, it would have moved up here, broken out again on volume, but instead we fail this higher low, undercut it. That's where you would be stopped out, whether your stop loss was moved up to this area or just at the original kind of low of the day area. But you can see after it moves back down below the 50-day moving average and 21 EMA, we reset, form another pivot, another short-term flag, and we get a nice breakout on volume. And that's when it goes and basically doubles in just a few months. So you always want to be on guard for a new setup to emerge, which you can profit from. So I think there's a really great example from this year of a setup reset that was extremely lucrative in just a short amount of time. You can see how strong this breakout was, riding that 5-day moving average to higher prices. So all in all, I think this is a really important video for people to watch, especially newer traders who are dealing with basically failed breakouts, are getting frustrated. It's important to remember that one good trade can pay for a ton of aggravation, a ton of basically small stop loss hits, and you basically have to manage risk, because if you don't manage risk, you're going to be stuck with a 20% loss, 30% loss, which can set you back basically weeks and months of progress. So you want to make sure that you're managing risk in real time and honoring those stop loss points. You also want to make sure that you know the environment. Are you in a situation where breakouts are likely to work or fail? That's very important. And basically look at that longer term trend of the indexes and the stocks and basically decide, are we in a stage 2 uptrend or a stage 4 downtrend? And finally, remember that you basically want to exit when the setup/trade fails. And even if it does fail and you get stopped out, don't become frustrated. You can always re-enter if it does set up once again. And often the best trades have multiple shakeouts before they end up working. So with that said, I hope you guys enjoyed this video. If you did, please go ahead and leave a like down below. Subscribe if you're new. If you have any questions on the material, go ahead and leave it down below in the comment section. And also let me know any topics of tutorials that you'd like to request. Just let me know down below and I'd be happy to make those for you guys. So thanks again for watching, and I'll see you guys in future videos. Take care.